The average American retires at 65. The average American loses their health at 66.1. That's 13 months, and I'm going to show you the real number you need to retire 7 years earlier than you've been told. Exactly why most retirement calculators are structurally lying to you, and who specifically benefits from keeping you at that desk longer than you have to be. I want to be precise about the health data before anything else, because this is the foundation everything else stands on. The World Health Organization tracks something called healthy life expectancy. Not how long you'll live, but how long you'll live without serious physical limitation or chronic disease severe enough to restrict what you can actually do with your days. A researcher named Jeff Nobbs compiled the international comparison into a readable chart. Japan leads at 74.1 years. Singapore is at 73.6. Korea at 73.1. Switzerland at 72.5. Cyprus and Israel at 72.4. Spain and France at 72.1. Iceland at 72. Italy at 71.9. The United States comes in at 66.1. Not competitive, not close. Behind every wealthy nation in the dataset by a margin that should genuinely disturb you. 66.1. The retirement age everyone in this country has been trained to aim for is 65. You get 13 months. Think about what those 13 months are supposed to carry. The travel that's been postponed for decades. The physical experiences you planned to prioritize once work stopped taking everything. The ability to move through the world on your own terms. Hiking trails you bookmarked. Sailing. Being present with your grandchildren without sitting down every 10 minutes. All of it was supposed to fit in a window that, on average, is 13 months wide. And most people spend a meaningful chunk of those 13 months decompressing from the job they spent 4 decades at. Because the human nervous system doesn't just switch off like a light. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. They ignore sequence of returns risk and asset allocation drag. Mine uses the same logic BlackRock and Vanguard use internally to stress test portfolios. It exposes the weak points in your plan before reality does. Link is in the description. I only ask for your email to send you the report. I don't store your financial data on my end. Now, the image I want you to carry through this entire video is a gas tank. You have a tank of good years. It is running right now. Not when you're on vacation, not only when you're exhausted, all the time, continuously, whether you're in a Tuesday morning meeting or on a Tuesday morning mountain trail. The tank does not pause while you accumulate a larger brokerage balance. The tank does not know the difference between a day you chose and a day someone else scheduled for you. The only question, the only one that actually matters, is who controls how those good years get spent. Right now, for most people, the answer is not them. Every year you delay retirement to hit a number that keeps moving, you are spending irreplaceable time from the tank on someone else's priorities. That's the frame. I'll come back to it. Let me tell you about Thomas. Thomas was a project manager at a logistics company in Ohio. Disciplined saver, competent investor, played the game exactly the way he was told to play it. By 55, he had $900,000 saved and a clear finish line in his head. His financial advisor ran the numbers on a standard projection tool and told him he needed $1.2 million to retire comfortably. Thomas said, 5 more years. I'll get there, and then I'll go. He hit $1.3 million at 62, the trip he had been mentally planning for 15 years. 3 weeks walking the Camino de Santiago across northern Spain. Something he'd read about in his 30s and promised himself was not available to the 62-year-old version of him the way it would have been at 55. The knees said no. A chronic back issue that had been manageable behind a desk became the loudest voice in the room when he tried to carry a pack for 8 hours. He did fine financially, comfortable retirement, no debt. no crisis. But the life he had been funding for 3 decades was no longer accessible to the body that had to live it. Thomas isn't a tragedy. Thomas is the average. And that gap between the life you were saving toward and the body you arrive in at 65 is the thing nobody includes in the retirement brochure. In a few minutes, I'm going to walk you through the actual math of early retirement and show you why your real target number is probably 15 to 25% lower than what any standard calculator is telling you. But first, I want to tell you where 65 came from. Because once you understand this, the entire retirement system starts looking like something built for a world that no longer exists. 1889. Germany. Otto von Bismarck introduces the world's first national pension system and sets the eligibility age at 65. Here's the detail everyone leaves out of the summary. The average German lifespan in 1889 was approximately 45 years. 65 was not a retirement age in any meaningful sense. It was a political gesture designed to cost almost nothing, because almost nobody would live long enough to collect. Bismarck wasn't being generous. He was being actuarially ruthless. The pension was funded by workers who, statistically, would die before the bill came due. The whole thing was engineered to be affordable at the exact rate of very few people using it. When the United States created Social Security in 1935, they borrowed the same number. Average American life expectancy at the time, around 60 years. Most people wouldn't collect for long, if at all. The math worked for the government the same way it worked for Bismarck, which is to say, it worked for the government, not for the people nominally being served by it. Now it's 2026. Life expectancy is around 76. Healthy life expectancy is 66.1. The number is still 65. Unchanged for over a century, while everything around it has been transformed. The financial industry, the advisors, the fund managers, the 401k administrators, the insurance companies packaging annuities at the exact moment you're most anxious about running out of money, built their entire fee infrastructure around that number. Every additional year you work is another year of contributions to managed accounts. Another year of expense ratios compounding in their favor. Another year of advisory fees calculated as a percentage of assets under management. I'm not calling this a conspiracy. I'm calling it an incentive. Incentives don't require scheming. They require humans acting in their own financial interest, which they do, reliably, every single time. Financial advisor, internally reviewing a client who wants to retire at 58. That's 7 fewer years of management fees. I'll need to update my projection model, and also my boat payment plan. The client sees a conservative revised number and a thoughtful expression. They never see the boat. I find this more funny than enraging. It's a system doing exactly what systems do. But knowing it changes how you navigate it. The tank doesn't care who set the age at 65. It runs on its own clock. Now, there are 4 ways the standard retirement plan loses value before you even start, and most people are experiencing at least 3 of them simultaneously without knowing it. Walk through these fast, because this is where the structural dysfunction really becomes clear. 1. The inflated target number. Standard retirement calculators project your current expenses into retirement without accounting for the significant chunk of current spending that is purely work-driven. Commuting, professional clothing, work lunches, the convenience spending that happens because you're chronically exhausted and buying time you don't have. The Employee Benefit Research Institute has found that retirees typically spend 20 to 30% less than while working, especially in the early, active years of retirement, when they're also healthiest. If your calculator is using your current spending as the baseline, your number is inflated. You're working longer to hit a figure you don't actually need. 2. The fee drag hiding in plain sight. Over 30 years, a 1% annual expense ratio on a $200,000 portfolio costs you approximately $170,000 in lost compounding. That is not an estimate. That is the compound growth math at a 7% average return. The difference between a 0.1% expense ratio and a 1% expense ratio, same portfolio, same contributions, same market. The gap at retirement is often larger than everything you contributed in an entire decade. The fund industry has no financial incentive to explain this to you. Many advisors are legally obligated to act in your best interest, but are employed by institutions with different interests. Read the fine print. It's all in there. 3. The behavioral gap. Dalbar Incorporated publishes an annual study on investor behavior that I want everyone to be forced to read. Over the past 30 years, the S&P 500 returned approximately 10% annually. The average equity fund investor earned around 6.3% over the same period. The difference, 3.7% annually, is entirely behavioral cost. Panic selling at market bottoms, re-entering at tops, reacting to headlines instead of staying allocated through volatility. On a $200,000 portfolio, compounded over 20 years, that 3.7% annual gap is approximately $300,000 in self-inflicted damage. The average investor during every significant market drop going back to 1929. I know I'm a long-term investor. I believe in the fundamentals. I don't panic sell. Also, the average investor, 2 weeks into the same drop. Okay, but what if this time is actually different? Maybe I should just move to cash until things stabilize. $300,000. Not lost to a crash, lost to the response to a crash. The market always recovered. The behavioral response locked in the loss. 4. Sequence of returns risk. This is the one almost nobody models, and it is genuinely dangerous. Your average annual return over 30 years is largely irrelevant if you retire into a 3-year crash and make withdrawals while the portfolio is underwater. Retire in 2007. Make your first significant withdrawal in 2008 when the S&P 500 dropped 60% peak to trough. 60%, and your portfolio may never recover the trajectory a linear projection assumed. This is solvable. A 2-year cash buffer, a flexible withdrawal strategy, a deliberately stress-tested allocation. These things handle it, but they require deliberate construction, not a default enrollment form. 4 known, quantifiable, documented ways the standard plan bleeds before it starts, and most people are spending 90% of their investing energy on a 5th thing, picking the right stocks. This is where I want to introduce someone. Call him Ray. Ray is a composite, built from patterns I've watched through 10+ years of running my own business, surrounded by accountants and fiscal lawyers who taught me how money actually moves, and the kind of conversations that happen when you've been close to that world long enough. Ray was 55, with enough. By any honest calculation, genuinely enough. But his advisor said a little more cushion wouldn't hurt, and Ray said okay. At 58, same conversation. At 61, same conversation. At 65, same conversation, except something had shifted. Ray had stopped wanting to leave. The goalposts moved so many times that the job became the identity, the accumulation became the purpose. Retirement, the thing Ray had been oriented toward for 30 years, became the thing Ray was quietly afraid of. Not for financial reasons, because the job was his social structure, his daily rhythm, his reason to get dressed in the morning, his context for every meaningful conversation he had. He built the number. He forgot to build the life. Ray is 68, still working, healthy actually, lucky, but genuinely uncertain what he would do if he stopped. We're going to come back to Ray, because what happened to him is the deepest trap in this entire story. Deeper than the health data, deeper than the fee drag, deeper than the behavioral gap. Hold on to him. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. Okay, here is the single most important variable in your investing outcome, and it is almost certainly the one you've spent the least time deliberately managing. Asset allocation. Not stock picking, not market timing, not which sector is going to outperform next quarter. The fundamental split between equities and fixed income, and within equities, the split between domestic and international, between large cap and small cap. A landmark study by Brinson, Hood, and Biebauer, published in 1986 and replicated multiple times in the decades since, found that approximately 90% of portfolio return variability is explained by asset allocation, not stock selection, not timing, allocation. You think stock picking is the problem. Actually, allocation is the problem. Everything else, the Reddit threads, the earnings calls people treat like podcasts, the hot sector plays, the technical analysis candles, the hours spent reading about individual companies, all of that combined explains somewhere between 5 and 10% of outcomes. And yet most people spend 90% of their investing time and emotional energy on the 5 to 10% variable, while the 90% variable sits on whatever a target date fund defaulted to when they enrolled in their 401k at their first job. Think about what that means. Your asset allocation. The variable responsible for 90% of your investing outcome was almost certainly set by an HR enrollment form you filled out in your mid-20s, while simultaneously trying to figure out which health insurance tier made sense. It has probably not been revisited with any real rigor since. Your portfolio has been compounding on that accidental decision for 15 or 20 years. This is exactly why lazy investing wins, not as philosophy, as math. I have multiple hundreds of thousands of dollars currently invested. Not in meme stocks, not in anything that generates an interesting story at a dinner party. In deliberately allocated, low-cost index funds with an allocation I set intentionally and rebalance once a year. I read the boring documents, the SEC filings, the fund prospectus, the relevant sections of the tax code, and then I do the boring thing. The returns are consistent, tax efficient, and they compound without requiring me to be emotionally available to them. 10 years ago, when I was running my business with accountants and lawyers around me every day, the most useful thing they taught me wasn't any specific strategy. It was that people who make money quietly, reliably, are almost always solving the boring 90%. The people who lose it are almost always chasing the exciting 10%. Here's a story that illustrates this clearly. A woman in Chicago, real case, details changed, managed her own stock portfolio for 20 years. Passionate, studious, genuinely skilled. She read everything, followed earnings, understood the companies she owned. Her annualized return over that period, approximately 8%. Her neighbor put the same monthly contribution into a total market index fund, set up automatic deposits, and went on with her life. Her annualized return? 9.2%. Same 20-year period, same starting amount. At the end, the neighbor had over $400,000 more. Not because she was smarter or more disciplined, because she didn't interfere. She solved the 90% problem once, accurately, and then spent her Tuesdays doing something she chose. That is the good year's tank in investment form. Every Tuesday, the stock picker spent monitoring her portfolio. The index investor spent from the tank on her terms. The math rewarded the one who did less. Now here is where I run real numbers. No rounding, no vagueness. This is the case study that should make you go back and recalculate your own timeline. Marcus, 42 years old, annual income of $120,000. Current retirement savings, $180,000 in a 401k and $40,000 in a taxable brokerage account. The default calculator on his retirement platform told him he needs $2 million and will get there at 65 at his current savings rate. 23 more years of scheduled obligation. Let's stress test this properly. First, the real spending baseline. Marcus tracks his expenses carefully. He currently spends about $8,000 a month. When he goes line by line, approximately $2,200 of that is directly work-driven. The commute, the professional wardrobe that serves no purpose outside business hours, the lunches, the subscription services he pays for, because canceling them requires 30 minutes he doesn't have. And what he honestly labels exhaustion spending, the delivery orders and unnecessary convenience purchases that happen because he's too depleted by 9 p.m. to make better decisions. Remove all of that from his retirement budget, and his actual monthly need is around $5,800. That's $69,600 per year. Apply the 4% rule. William Bengen's 1994 framework, stress-tested through 2001 and 2008 without failing. And Marcus's real target is $1,740,000, not $2 million. Already a gap that changes the math on his timeline. Second, tax optimization. Marcus maxes his 401k, $23,000 in 2026. He opens and maxes a Roth IRA at $7,000. He starts a health savings account and contributes $3,850, invested in index funds rather than sitting in the default cash sweep option most HSAs put you in without asking. Total annual tax-advantaged contributions, approximately $33,850. The 401k contribution alone saves around $5,000 in federal taxes at the 22% bracket. The HSA invested over 20 years compounds into a substantial tax-free healthcare fund. Fidelity estimates a retired couple will spend approximately $315,000 on healthcare costs in retirement. Marcus is building that buffer automatically in a vehicle that is triple tax-advantaged, without thinking about it after the initial setup. Third, and this is the move almost nobody makes consciously, Social Security delay. Marcus retires at 58. He does not claim Social Security. He draws from his portfolio for 12 years. At 70, he claims at the maximum benefit, including 8% delayed retirement credits for every year past his full retirement age. That 8% annual guaranteed return on a delayed Social Security claim is one of the highest confidence return strategies available anywhere in the investment landscape. The stock market does not guarantee 8%. Treasury bonds certainly don't. And during those 12 years of delay, his portfolio continues compounding with reduced annual withdrawals. Run this through a Monte Carlo simulation that accounts for sequence of returns risk, not a linear projection, and Marcus retires at 58 with high confidence of never running out of money. 7 years earlier than 65. 7 more good years in the tank, spent on his schedule. For the healthcare question before Medicare at 65, yes, unsubsidized marketplace coverage for a 60-year-old can exceed $1,000 a month. That's real. But if Marcus manages his reportable income through Roth conversions and tax gain harvesting, his modified adjusted gross income in early retirement can qualify for Affordable Care Act subsidies. This is not a gray area or an aggressive strategy. It's how the ACA was written, in the statute, publicly available. Most people don't read the statute. They get general advice from someone who doesn't have time to model their specific situation. One of the more useful things I absorbed from years surrounded by fiscal lawyers is that the actual rules are frequently more favorable than the general summary suggests. You have to read the documents. Now, the part that doesn't appear in any calculator, any retirement platform, or any financial advisor's standard presentation, the Harvard study of adult development has been running for over 80 years. It has tracked hundreds of individuals from young adulthood through late life, the longest longitudinal study of human happiness in history. The finding is consistent across every cohort, every decade, every update. The quality of your relationships is the single strongest predictor of both health and happiness in later life. Not net worth, not career achievement, not the size of the account. Relationships and purposeful engagement. The people with the warmest connections in midlife were the healthiest and most cognitively intact at 80. The people who had accumulated the most, without investing comparably in their human architecture, showed the worst outcomes. And this is where Ray's story closes. Ray built the number. He forgot to build the life. After 30 years of outsourcing his social structure, his daily purpose, and his sense of identity to a job, the job became genuinely irreplaceable. Not financially, but psychologically. Retirement stopped being the destination and became the threat. He's 68, in decent health, sitting on a tank with plenty of fuel and no route planned. That's not freedom. That's a different kind of stuck. The people who thrive in early retirement share one pattern that is visible in both the research and in every real case I've watched up close. They did not retire from something. They retired towards something. They built the relationships, the projects, the communities, the purpose, in parallel, while still working, sometimes for years before they actually left. And when retirement came, it was not an ending. It was a switch from part-time to full-time in a life they had already been designing. Start building the life now. Not the number, the life. Here are 3 things to do this week, specific to everything in this video, not generic advice you've already heard. The first is to calculate your real number. Sit down with your actual spending, strip every work-related expense, and apply the 4% rule to what remains. Then model Social Security delay as a separate guaranteed income stream starting at 70, completely separate from your portfolio math. In most cases, your real target is 15 to 25% lower than the default output. That changes your timeline more than any investment decision you'll ever make. The second is to audit your asset allocation before you look at anything else. Not your individual fund performance, not your stock picks, the allocation. Run an honest self-assessment of your actual risk tolerance, not the theoretical version, but based on how you actually felt in March 2020, when the S&P 500 dropped 34% in 33 days. Or whenever you last watched a significant chunk of your portfolio evaporate on a screen. Match the allocation to that person, not the investor you imagine yourself to be in a rising market. Keep expense ratios under 0.2%. Set a calendar reminder to rebalance once a year. Then, do not touch it. The $300,000 of behavioral damage I described earlier comes entirely from touching it at the wrong time. The third is to start building the life before you need it. The Harvard data is unambiguous. The retirement transition research is unambiguous. You cannot retire well toward nothing. Start now. The relationships, the purpose, the community, the structure that doesn't depend on a salary to hold it together. Not because it accelerates your financial timeline, though it might. Because the tank is running and you want somewhere worth going. Lazy investing built more fortune than crypto memes. The people I know who built real, early retirement funding, durable wealth. Not the people with the most entertaining portfolio stories, but the ones who actually stopped working on their terms while their tank still had gas in it. They solved the 90% problem once, deliberately, and then went and built a life. They kept their allocations honest, their fees low, their behavior disciplined. The finish line was painted in. The finish line was painted in the wrong place by a German politician in 1889 for reasons that had nothing to do with your freedom. The industry kept it there because it's profitable to keep it there. And the average American, following the most responsible-sounding conventional wisdom available, arrives at 65 with 13 months of healthy retirement and a greeting card from colleagues. That number can be different. The math says so. The tank is running. Go somewhere worth going.